Hi, I am Anna. I come from www.ntvforex.com. Divergence and Corrections Analysis http ntvforex.com News ID C077119 2024 47:42 am Financial markets showed some signs of divergence overnight, as an underwhelming US ADP employment number rattled the confidence of the wall of fast money positioned in the buy everything trade. ADP employment rose by 428,000 jobs, positive, but well short of the 950,000 gain forecast by markets. Although both the Nasdaq and S&P 500 finished higher, the rally was driven by a strong rotation into defensive sectors such as financials and utilities, at the expense of technology. Meanwhile, US 10 and 30-year yields both fell strongly as nerves increased that Friday's non-farm payrolls would disappoint. The US dollar corrected higher with both gold and oil suffering substantial falls. The divergence between the trajectory of US yields and equities versus the US dollar, energy, and precious metals implies that the greenback is still the haven of choice. The price action also means that much of the recent FOMO buy everything prices action recently is non-sticky tail chasing fast money that heads for the exit door at the first sign of trouble. We are likely to have more days like this ahead, with an acceptance that higher intraday volatility is a side effect of the democratization of financial markets via online platforms. That money is noisy and is desperate to extract every tick out of every move. Stepping out of the herd's FOMO noise, the fundamentals for higher equities, a lower US dollar and higher precious metals remains firmly in place. Falling US real yields with a Federal Reserve and its quantitatively easing central bank coterie prepared to keep rates lower for much longer. The shocking state of the US government's fiscal accounts that already had a $1 trillion deficit before COVID-19 leading to fears of currency debasement. The hunt for yield anywhere, and signs that the rest of the world is, slowly but surely, modestly recovering from the pandemic. NBSP rather than looking for conspiracies everywhere, which is tiring on a daily basis, an acceptance of higher intraday and probably weekly volatility should be the longer-term investor's modus operandi. It's either that or lots of Panadol. Like Douglas MacArthur, the buy everything trade shall return in all its glory. That economic recovery was reinforced by China once again this morning, Cakes and Services PMI printing at a still expansionary 54.0, for the fourth month in a row. That Asia will probably lead the world out of the pandemic recession should surprise precisely no one, although the recovery will be uneven across the region. That has lifted spirits in Asia today with the region's major equity markets mostly in the green. More talk of fiscal stimulus from the South Korean government, and a BOJ official stating that the central bank must cut rates further and quantitatively ease more has also helped lift the mood. That has helped sweep any fallout from the lower than expected July Australian trade balance, 4.6 BIO vs 5.4 under the carpet, despite a worrying 17.70% fall in exports to China. Australian investors appear to be treating the latter number as a mere flesh wound, and despite China and Australia's tense relations, core exports will stay intact. German and French services PMIs are released this afternoon, with both expected to show substantial increases. With the euro on the back foot overnight, after the ECB's chief economist expressed disquiet about the high level of the currency and its deflationary effect on import prices, weak readings could be enough to tip the single currency into a deeper correction. Tonight's U.S. initial jobless claims will assume greater importance after yesterday's disappointing ADP employment data. Initial claims are expected to fall to 950,000, a slight improvement over last month. Continuing claims are expected to fall to 14 million. With no sign of a follow-on fiscal stimulus package from Capitol Hill, an unexpected rise in initial and continuing claims could see more haven inflows into the U.S. dollar, deepening the correction, even as U.S. bond yields would inevitably track lower. That could spill over into energy and precious metal markets, although only a brave man would stand before the FOMO gnomes of Wall Street in equity markets. Bad employment means lower interest rates and more easing equals buy equities. Positive data indicates the economy is recovering equals buy equities. It's that simple, even if I sound jaded saying it. Equities are mostly higher in Asia, hints of more stimulus in South Korea and Japan, along with another strong service PMI print has lifted North Asia today. That followed yet another strong close by Wall Street indices overnight. The Nikkei 225 has climbed by 1.0%, with the Kospi jumping an impressive 1.35%. Mainland China's Shanghai Composite and CSI have both edged 0.20% higher. Australian markets have ignored the trade balance completely, preferring to concentrate on a lower Australian dollar and positive China data. The ASX 200 and all ordinaries rising 0.90%. With Wall Street rotating in defensive sectors, and the US dollar falling, regional Asian markets have fared somewhat worse, being more vulnerable to fast money rotation than their big brothers. Hong Kong has paused for breath, declined 0.30%, perhaps with investors cashing up to bid for the upcoming Ant Financial IPO. Singapore is down 0.50% after manufacturing PMI contracted once again, showing the city-state still mired in the worst recession of a generation. Peripheral Malaysia and Indonesian indices are down 0.60%, being more vulnerable than most to the nuances of international fast money beating a temporary retreat. Stock markets in Asia will continue to be a mixed bag between the haves and have-nots for the rest of the session. European shares are likely to catch the tailwind of a lower euro as their session commences. NBSP, the US dollar correction higher continues. The US dollar powered higher overnight as safe haven flows after the ADP employment data flowed US bond markets, pushing yields lower. The pace of the correction hinting that much of the recent short dollar positioning was of the fast money type, which needed few cues to head for the exit door. The dollar index rose 0.40% to 92.65 overnight, its second such gain in a row. This morning in Asia, the index has advanced another 0.20% to 92.84, just shy of its overnight high. A move through 92.87 could signal that a deeper US dollar correction is upon markets, possibly as far as 93.50. The euro and Australian dollars both suffered 0.50% losses, with the British pound falling by 0.25%, supported by selling in the Euro GBP cross. That pattern has continued into Asia with Euro, GBP, AUD, GBP, and CAD all 0.20% lower amongst the pro-cyclicals. The euro has support at 1.1770, with GBP support at 1.3300 and AUD at 0.7300. A failure of these support zones will signal deeper corrections ahead of tomorrow US non-farm payrolls. Overall, the price action looks corrective, and not structural. The fundamentals driving US dollar weakness are as strong as ever, particularly the overnight fall in US long bond yields. Bears may have to endure more pain yet into the end of the week, although a positive jobless claims figure tonight would alleviate the bearish noise. Tomorrow's non-farm payrolls data is gaining in importance by the day and will likely dictate how far the dollar correction will run. Oil suffers a pipeline burst. Oil markets endured their most torrid day in weeks as a rotation out of risk positioning, and a stronger US dollar weighed heavily on energy markets. Again, the price action overnight looks to have highlighted the fast money nature of oil's recent gains, as a massive drawdown overnight in US crude inventories was ignored entirely by markets. NBSP Brent crude fell by 3.0% to $44.30, surrendering its 200-day moving average DMA at 45.60 a barrel. The August 21 low at $43.60 a barrel looms as must-hold support for Brent crude. Failure opens up a deeper correction to $42 a barrel. WTI fell 3.35% to $41.44 a barrel, just above its 200 DMA at $41.25 today. Looking for any excuse to lighten positioning overnight, traders noted a rise in gasoline inventories. Still, the real story is a fast money rotation out of long positioning established at the top of the recent ranges. A daily close below $41.25 implies further losses to the $40 a barrel area, and possibly as low as $39 a barrel. Both Brent and WTI are unchanged in moribund Asian trading, as the region's participants adopt a wait-and-see approach ahead of US data this evening and tomorrow. Physical buyers, having looked at the overnight price action, appear to be taking the view that they will find better entry levels into the end of the week. Gold fingers get caught in the exit door with price gains having stalled over the past few days. The US dollar rally, and haven flows into US bonds, was all the signal fast money longs needed to rush for the door. As ever, the exit door was smaller than the number of traders attempting to exit, and gold suffered a 1.40% decline to $1,943 an ounce. NBSP gold has quite strong support in the $1,905 to $1,920 an ounce zone, which has limited all sell-offs of the past 3 weeks. With gold's bullish fundamentals unchanged, we will likely see that same interest to buy dips appearing again should gold move lower from present levels. That said, a failure of $1,900 an ounce likely signals a deeper correction to the August 12 lows around $1,863 an ounce. Longer-term players need a strong constitution, patience, and an appetite for volatility in today's markets. Gold has tried to move higher in Asia, but the rally has been quickly rebuffed, leaving the yellow metal almost unchanged at $1,943.50 an ounce. Asia will likely retreat to the sidelines now, and allow gold's next direction to be set by the New York time zone. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://mt5.expert.advisors.